Well, good morning. Welcome to another Financial Friday. Thanks for tuning in today. My name is Matthew Atkins. I'm the Senior Financial Advisor with Clearbrook Investment Management and also a National Social Security Advisor certificate holder. This morning we're going to finish up kind of our Life Insurance Awareness Month features. And so I want to talk a little bit, as you can see on the chart behind me, about some of the costs, because one of the really common things that people talk about in life insurance is, particularly some of the media people, is, buy term and invest the rest. That's their kind of standard mantra. And if you listen to Susie or any of the other kind of televised people, they oftentimes will just say, be sure you buy term insurance. And so I just want to talk really quickly about the real costs of those types of insurance policies. And I'm going to look at three different types. So you've got term insurance, you've got a return of premium policy, and then you've got permanent insurance, either index universal life or whole life type of investment product. Both of these are 20-year terms, so you might not even be aware of return of premium, but there are return of premium policies, and I'll explain that a little bit as we move along. And what I'm doing is I'm using a kind of standard rate, which is a 40-year-old male, non-tobacco user, $100,000 life insurance policy, which may be way less than what you need, or maybe you think it's more than you need. And again, we're looking at 20-year term versus permanent. So 20-year regular term, 20-year return of premium, and we're looking at permanent insurance as well. So I want to take a look at the cost per year and then analyze some other things as well. So first, term insurance is obviously the cheapest, $300 for the year, each year that you have in term insurance. Return of premium is going to cost you a little more, about $800. Permanent insurance policy is going to cost you a little more than that, about $1,300. So when you look at the total cost over that 20-year term, you've got $6,000, $16,000, $26,000. So when you just take a quick look at it, you think to yourself, holy smoke, that is way more expensive than buying term insurance. And of course, if you don't have the cash flow to do it, then you're probably going to lean towards one of the other ones here. But we want to look at some other things as well. What's the cash value? What do you have at the end of that 20 years? Well, with the term insurance policy, you have nothing. You have no value. You've essentially rented life insurance, just like you rent car insurance. You pay monthly or you pay annually, and if you don't have an accident, you don't get anything out of it. Okay, return of premium, however, at the end of the 20-year term, you can actually get that premium back. So you've spent $16,000, you can get $16,000. Now with the permanent insurance policy, we're just looking at guaranteed values, about a 3% growth rate that's guaranteed by the insurance company. At the end of that 20 years, you have a cash value of $27,000. So you invested $26,000, but you have a cash value buildup already of $27,000. Well, what about after that time? So now you're 60 years old. We were looking at a 40-year-old male, remember, $100,000 in coverage. Now you're 60 years old. Well, what about health in 20 years? Well, obviously, nobody can predict that, so we're not sure, right? We're also not sure here. And here, with permanent insurance, it doesn't matter. Who cares? Why? Because you don't have to requalify again at 60. You've got a permanent policy. It goes on until probably 100 years of age. And so you don't have to requalify. And if you've had medical problems over the last 20 years, then in these two, you could end up having either uninsurability or you could have a significantly higher rate. So let's take a look then at cost at year 60. What happens to term insurance versus a return of premium policy versus a permanent policy? Well, at age 60, because now you're much older, your insurability goes down, the risk goes up for the insurance company, and so we can price that out at about $1,700 per year. So you've gone from $300 a year to $1,700, which is still just a little bit more than you started out here. But, significant jump there, $1,400. With the return of premium, you're going to be looking at $3,300. $3,300 a year, so almost double, what you're paying in the permanent insurance policy. What about with the permanent, like a index universal life policy? Well, guess what? You're still going to be paying about $1,300 a year. Why? Because that's a level premium policy, so it doesn't change just because you've gone forward 20 years. So what happens in the total cost of insurance between 60 and 80? Well, here's where it gets really interesting. Your total cost of insurance between 60 and 80 for this policy is now $34,000. Okay, so $34,000 you've invested in that insurance policy. Again, if you die during that time, then you're going to get that benefit. However, if you don't die during that time, you've just rented insurance for another 20 years. What about the return of premium? Well, here you're looking at $66,000. Total cost of insurance from 60 to 80. Now, the beauty is that if you decide you're going to cancel that policy at 80, you're going to get back that 66K. So you actually have a cash value even at year 80. You're going to be able to get that back. With the term insurance, no cash value. So you've just rented it, you spent $34,000, and you've got nothing to show for it whatsoever if you cancel that policy. What about with the permanent policy? Well, here's the amazing thing. What's the total cost during that time? Well, 60 to 80, 26K. So now you start to see that that level premium has far surpassed in value the cost of these other two. Total cost, guess what? $52,000. $52,000, still less than what you've paid for the return of premium in just the cost from 60 to 80. So here's the next question. What happens if you're healthy still and you'd like to have your insurance go on even past 80? Well, guess what? If you get here and you want to buy term insurance at 80, you're no longer insurable. You can't find a term policy that's going to give you that. And if you can, it's going to be unbelievably expensive to do that at 80 because the risk for the insurance company has just skyrocketed. You're now getting to a point in life where they know they're going to pay out a death benefit before too long. Okay, what about return of premium? Same situation. Non-insurable. You're not going to find a return of premium policy. So you might have got back all that you've invested here at age 80, but you don't carry any of that into your life. Now, the beauty is at 80, you might say to yourself, well, I don't need life insurance, so I can actually take that money, invest it somewhere else, and use it for my end-of-life costs. Wonderful idea. That's what return of premium provides you with that benefit. What about for the permanent policy here? Well, in the cash value world, we've already got $82,000 built up in cash value by the time you're 80. Again, that's a guaranteed rate. You say, well, what's that good for? Well, what if you want to take a trip? You can borrow from that $82,000. You can take from that $82,000. What if you want to spend it on something else? You can take from that $82,000. You've got a cash pool there that you can access and use any way you want to at that point in time. But not only that, after age 80, you're still insured. No more medical exam, no nothing. Your insurance will continue on right on through to age 100, 105 sometimes, 120 on some policies. So you have tremendous opportunities. And so the real question when you're analyzing what's the best insurance for me to get, if you're a young person, for example, a 40-year-old like we talked about, in this case a 40-year-old male, non-tobacco user, you have to make sure that you're analyzing all the costs involved. And not only all the costs, but all the benefit that you might get out of that policy. Now, that doesn't mean a permanent policy is for everybody, nor is a return premium policy, because some people just simply can't afford to do anything other than term. That's fine. But when you take a look at it, you at least have to ask the question, which one of these makes the most sense in your circumstance? And if you come in with a bias that permanent policies are really ridiculous and you should never do it, you're going to miss the opportunity to analyze which one really makes sense for you. So my encouragement is when you're thinking about buying life insurance, at least take the time to say, okay, let's compare dollar for dollar, value for value, which one makes the most sense. And then you answer the question, which one do you look at and go, well, I don't want to do this one, and I would consider these two. Or I don't want to do these two, but I would consider this one. You make the decision. Next week, we're going to look at some other kind of broader financial things, particularly about investing and how to invest with a company like Clearbrook Investment Management. I look forward to talking to you. Hope you have a great weekend. We'll talk to you next week.